The next technique which I would like to discuss with you or share with you is the method, which is probably the most widely used method, and that is called the net present value method. This is one of the, as I said, that this is very common technique used. But as a disclaimer, I must say that no single technique is enough to make a decision to accept a project or not to accept it. So you have to follow. And moreover, one technique is not enough for one stage. So you have to apply the same technique in multiple stages sometimes. And then not only that, you mix it with many other techniques. And then at the end of the day, based on multiple techniques, you arrive at a conclusion that I think, to our best of knowledge and belief, this project is acceptable, and these are not acceptable. Okay, and once you shortlist those acceptable projects, then you go for funding. The next stage is that now we should find money to fund those projects, to run those projects. The method I want to discuss with you is net present value method. The net present value method is, first of all, we need to understand that one of the key objectives of a company is the shareholders' wealth maximization. This goes back to the discussion we had yesterday, that a company is owned by the principals, but controlled by the agents. And these agents are, since they are recruited by the principal, since they are employed by the principal, hence there is a expectations from them that they will do nothing which jeopardize the interest and the stakes of the principal. This sounds a little bit very capitalistic, that are managers only responsible to the shareholders. All right. In the modern world, this theory, this idea seems to be very subject to criticism. That company is not only a profit-making machine. The manager of the companies are not only responsible to the shareholders. The only job is not to look after the interest of the investors. The modern day corporates, they go beyond the investors. They are corporate citizens. They are entities, and they have to look after the interest of the other stakeholders as well. We discussed yesterday that there could be many types of stakeholders. Okay. We go beyond that, but the fact remains that when it comes to the making a decision, shareholders come up with more force and power because they have the voting rights. Remember, stakeholders don't vote. Who will vote? People who own the shares, who own the stocks.
You know, the rights.
Who have the right to vote. Yeah.
Not everyone.
Yeah.
It's not democracy.
Yes, I wanted to come out that point, but in a slow by slow manner, because many people don't understand this idea. They have the voting rights. They vote. That is why they have a last laugh. So that is why the shareholders will like it or don't like it, they play a very strategic role in the decision making. Okay, and the way the managers choose the projects based on the net present value is that they forecast the expected cash flow. It's very important that you have a look at the cursor, that they forecast that if this project X is undertaken, these are the cash flows or cash streams which company would generate during the lifespan of the project. But then we also know that these cash flow will come at the end of year 1, year 2, year 3, and the world is dynamic. The dollar you get today is not worth the dollar you get tomorrow or after a year, after 10 years. Therefore, we need to multiply it with the discount factor. The discount factor includes two things. Discount factor includes the time value of money. We all know that over the time, the value of money goes down. We often see our grandparents discussing that in 1940, this was the salary we used to get, but we still have a better lifestyle than people who have nowadays. Well, if they had less money, then the inflation was also low at that time. So the value of money was higher. So over time, the discount factor includes the time value of money, which deteriorates, which goes down. At the same time value of money is not the only thing. We also include the other risk factors. All right. The other risk factors means which can hamper, which can cause you, because you also foresee, you also make some kind of expectation that what type of risk your project can face. Imagine you have two projects. The one is a Finnish company undertaking in Finland. And the second is the Finnish company taking in a very remote country, far away, maybe in Africa or maybe in Latin America or some far away in some Asian country. Both have same inflation rate, imagine. But the political climate of this small island where the Finnish company is thinking is very hostile. There's always a danger that there will be army coup. There are no financial markets. If they are completely in a disarray. There could be economic uncertainty. You never know, GDP would be 2% or 10%. So there's a more uncertainty involved. And because of that, if you want to invest in that country, which I'm talking about, less known country, then what happens is that you apply a bigger discount rate. So I give you an example. If you think that the inflation rate in both countries is 2%, in Finland and this unknown but very dangerous country, but then you can also find that the political, social, cultural, institutional climate is extremely volatile in this less known country. So what you do, you add 5% extra. So whereas in Finland, you will be discounting your cash flows at 2%, right? Whereas in this country, you can be discounting at 7%. So basically, the 100 euro, which you get after 1 year, would be, let's say, worth 98 of today in Finland, but they would be 93 in this another country, because you are using a higher discount rate. And when the new ventures go in the global markets, they come across two problems. The first problem is that you see the potential risk of the project, but you also see the potential risk of the country where you're going to. Like in Finland, if a Finnish company is investing in Finland, there's no country risk because you are in the same country. But when a Finnish company is going abroad, especially when you're a small new venture, then the risk is even higher because you don't have much reserve capital with you. If you lose everything. It's not like a Coke subsidiary in Malaysia, if loses money, it can get immediate transfer of funds from Indonesia. You can't get it because that's the only project you have. So in that case, what happened is that you are encountering a higher discount rate. Discount rate, as I said, is a type of opportunity cost of capital, which includes two things. The first is the time value of money, which goes down because of inflation. But on top of that, it includes the risk factor, which come from the country and the company specific. You may be investing in a very risky project in a safe country, but you can be investing in a very safe project, but in a very risky country. Or it could be that you invest in a very risky project in a very risky country. So all these combinations can make you choose or select a different discount rate. Okay. Sometimes you do the calculations by yourself, but many times it happens that a small and medium enterprise don't have this capacity to do this calculation. So in that case, you can even see some published data. Okay. The best friend is Google, of course. I want to show you. Do I have this? Wait a sec. Maybe. Okay. So I thought that maybe it's a good point that I should discuss with you that where this rate of discount come from. The rate of discount come from, I repeat, the rate of discount shows two things. It shows time value of money, which goes down over time. And secondly, it shows risk factor. And the risk factors are external and internal to the project. Okay. And then we multiply the two and we find some value. I'll show you one example soon. And then we subtract the cost of the project. Then we minus the cost of the project. And if the net present value is positive, if the NPV is positive, more than 0 or positive, then a project is, I will not say accepted, but the project will be now qualified to be accepted for the next stage. You get my point? The project qualifies to be considered. But if a project is 0 or negative, then it's a straightaway rejection, straightforward rejection. That project will never be considered.
Yeah, well, there might be some cases.
When you apply this NPV formula or any formula of capital budgeting, you must know when you are doing this calculation. And you always do this calculation in time 0. Time 0 means now. Okay, so you can see that in this formula, the only thing which represents time 0 is C0. And C0 is initial investment, which you can do right now. And then C1 would be the cash flow coming in at the end of year 1. C2 would be cash flow coming at the end of year 2 and 3 and 4 and 5, depending upon the project life. Here we go. The rule is very simple. You have sometime you are in a position to discuss that should we invest or shouldn't we invest at all. The debate is not that which project you should invest in. Sometimes the debate is, should you even invest? Or should you let the money in your bank account? Or should you just do nothing? Just continue what you've been doing now. So you can see that if a company has a cash in the bank, 1 million, and your other assets are 9 million, it means the company's total book value is 10 million. The company is considering to buy a new machine for 1 million. It means that if company buys this machine, if it buys, the cash would be 0 because you are investing. But at the same time, there will not be any additional increase in the other assets, will remain same because that is what you're doing, the other things. But when you spend 1 million, you will be getting the present value of the future cash flows. And if this cash flow is more than 1, or if 9 plus PV is more than 10, if 9 plus PV is more than 10, it's worth taking the project. But if 9 plus PV is equal to 10, then working and not working, taking the project or not taking the project makes no difference. And if 9 plus PV is less than 10, then you have taken a very bad decision. or you may take a very bad decision. If 9 plus PV is positive, you should consider the project. Because if 9 plus PV is more than 10, let's say it's 11. Let's say it's 11. It means that the present value of project would be 2. And you invest 1. You invest 1, you get 2. Makes sense. If N plus PV is also 10, it means PV is 1. 9 plus 1 is 10. So if PV is 1, it means that you invest 1, you get 1. What difference it makes? Nothing. And if 9 plus PV is less than 10, which means that, let's say this is 9 altogether, so PV is 0. So you invest 1, again, get nothing. What could be worse than that?
Let's say the first column projected, that is today, right?
Everything is today.
And the other is also today.
Today, you are accepting, you are deciding to invest or not to invest.
Okay. But if you just decide to invest, obviously you will receive future cash from the project only starting tomorrow. So that is what I mean.
Both are today. If you are in a position to convince yourself that the future, look, everything is in time 0 now. If you are able to estimate today that for the next 5 years, the cash flows which come are here, and when you add the total value of the company, the existing assets plus the new cash flow comes, 9 plus PV is more than the existing situation, then this project is worth undertaking.
Okay, just to summarize. The first column is today, no adjustments. The second column is we go to the future, but since
we estimate the future cash flows today.
Since the future and today are
let me complete it. Otherwise,
then we come back to today with that future. Is that
both are today? Here you calculate today the sum of future cash flow if you invest. Look, you can't just invest and leave on destiny how much cash you get. You have to forecast some cash flows, and you forecast cash flow today. That I will be getting, my estimate is that macroeconomic factors are promising, the project is in demand, demand is there, it's a new venture, blah, 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 all the factors. And then you calculate your future cash flow at the end of year 1, year 2, year 3, year 4, 5. And then you say that, hey, 5 year is the end of the project. And when you calculate this present value today, you find that the total of this side is bigger than total of this side. So if you accept the project, the value of the company would be higher than when you don't do anything. Okay? Then you are in a position to justify that I think this project is worth undertaking. Like, for example, if you look at this example here, you are estimating that this project life is 5 years. And let's say the project will cost you 100,000. I mean, if you don't undertake the project, your cash will be 100,000. Nothing is spent. But if you spend this money, then cash would disappear. But the project value will come. So the initial cost, if you undertake the project, is 100,000. This is the cost of machinery. Let's say it's the cost of the machinery. And you estimate that there'll be 25,000 cash flow each year till 5 years. So then in that case, this 25,000 becomes C1, C2, C3, C4, C5, 25,000, 25,000, 25,000. And let's say this project is for 5 years. And then what you do here, you find out that the rate of discount is not 0, but there is some risk. There's an inflation risk, there's a country risk, there's a project risk. And you find out that altogether the risk is 10%.
The rate of discount is just to include the interest rate, correct?
Interest rate plus the other risks.
Inflation and other risks,
Yeah.
whatever.
I can give you some names of time value of money is representing the inflation. Okay. There's an interest risk. If the interest goes up afterwards in the future, then your value of investment will go down. There's always a negative relationship between interest rate and the value of assets. I'll give you an example. Let's say you invest 1,000 euros and the rate of interest is 8%. Okay. How much interest you get? I guess 80 euros. Is it? I just want to give you an example that when the interest rate goes up, it's very risky for you as an investor. If the rate of interest goes up to 10%, when you invested, it was 8%. When after 1 year, the rate of interest goes to 10%, then guess what? To earn 80 euros, you don't need to invest 1,000. You need to invest only 800. It means that your assets book value is 1,000, but the market value is 800 now. So if you sell this asset, you lose 200. So as the interest rate goes up, the project value shrinks. Are you with me? If your project is 1,000, and let's say the interest rate which you will be getting, or let's say the rate of return you will be getting is 8%, then the interest which you get, this multiplied by this, is 80. But if the rate of interest goes up, guess what happens? Then the value of the asset goes down to 800, because then you can produce 80 with 800 only. It means that if you sell this project in the market, nobody will give you more than 800. So you have a capital loss. On the contrary, if in the future interest drops to 4%, then to get the same benchmark, you need to invest 2,000. It means you can sell your project for the double amount in the market. So there is a negative relationship between the rate of interest and the asset value or the project value. Project is also an asset, by the way. So here, if we assume, I go back to this example. Here, if I assume that you make this all calculation, I repeat, rate of discount, look at in this formula, all these numbers seem to be very big. R is just a small, but R is the most crucial factor. The most important thing in this formula is R. And if you imagine that R is 10%, then you can see that, you know what, I slightly shuffled the slides today, so maybe you have the printout. So I make it a little bit shuffle. This slide was a little bit behind, but I put it a little bit in advance. All right, good. So it means that if you have €1, this basically this 10% means that if you have €1 now, at the end of year one, this €1 would be around 91 cents. Look at the cursor. And this €1 after 2 years will be around 83 cents. After 3 years, this €1 is worth 75 cents. After 4 years, it's worth 68 cents. And after 5th year, this €1 is 62 cents. And when you multiply this and this column 2 and column 3, you get this much. It means that the 25,000 which you get today will be worth 22,725 after 1 year. So even though in terms of notes, you still get 25,000 after 1 year, but that 25,000 would be worth 22,725 today. And when you add them up, it comes to be 94,750. And what is this 94,750? This is sigma. This is sigma CT divided by 1 plus R to the power of T. And then you minus this initial cost of investment, which is now. If you take this project, you must invest 100,000. And what you get here is a negative. this project is out of question because it gives you the negative net present value. Okay. Of course, you can argue, as we discussed before, that maybe we choose it. Well, those are different dynamics. But I'm purely thinking from the financial calculation point of view.
In your calculation, are you using 10% as the interest rate of, fixed for the whole project, correct?
No, this is not the interest rate. This is including all the risks.
The 10% that you have there, is that interest rate? Or
no, this is the rate of discount.
Including all
everything. The rate of discount includes expected rate of inflation. I can say it loud again.
Yes.
The rate of discount includes the expected rate of inflation, which you see in Bloomberg or in Reuters or in Financial Times, or you make your own assessment. Plus, there is an interest rate that you also add. Plus, you add the expected rate of the currency depreciation. If your project is abroad, plus you also take into account what is the GDP forecast. Imagine you read an estimate that last year the Finnish GDP was expected to grow at 2%. This year the forecast is 1%. So there is an additional risk of 1%. If I'm a foreign investor going to invest in Finland, I would push my discount rate by 1 extra percent. If earlier I was using 5%, now I should use 6%. And if I find that, if I'm a Chinese investor and I find that euro will be depreciating by 2% against Chinese yuan, then I would add another 2% to my risk factor. So these things are, remember, all these things are not only confined to your firm and your four wall in the office. No, there's a life outside this office also. So the macroeconomic factors, even the political factors also. Now it's difficult to quantify that if you want to invest in a country and there's a danger that there may be an army coup, or there is a likelihood that there is at the moment, there is a pro-business capitalist government, but there's a chance that the new party comes in power will be very ultra left-wing.
Is this factor always negative?
Sorry?
Is it always negative?
No.
What is plus now? I'm always thinking here that is always negative.
So if you believe that a firm is a sum of projects, then the value of the firm would be sum of the value of the projects. And how you find the sum of the value of the project is with exactly the technique which we have discussed in cash flows. So for example, the sum of the value of this project is 94,750. Okay? And same way, you can calculate another project value, and so on and so forth. And when you add all of them together, then it gives you the total value of the firm. But remember, in this case, I'm not going to invest it because it's negative NPV. Okay? But all the projects which you invest in, and what is the parameter of investing? If NPV is positive. So imagine I have 5 different projects whose NPV is positive, and those are the only 5 projects I have, then the value of the firm would be equal to the value of total of the values of each of those 5 projects. That makes the value of the firm.
When you calculate the number of cycles,
Yeah.
Why 5? Why not 10? Or why not 2?
Well, I have to give an example. If you see, in this example, I gave you 5 years, right? But in Excel, I took 3 years.
Yes. So you can choose one. But what is the criteria that one should consider in the number of cycles?
Good question. It depends upon, you may forecast the working life of the project. If you know that this machine or this technology or this know-how or this formula is giving me cash flow for the next 10 years, then use 10 years. I give you a real example. GlaxoSmithKline, have you heard? GlaxoSmithKline. is a pharmaceutical company. Yeah, they develop the drugs. They develop these medicines. The WHO, the World Health Organization, rule says that after 20 years, most of the products become off patent. Off patent means anybody can make them. It means that if GlaxoSmithKline knows that they have spent $5 billion on developing a drug, and if this drug goes to the market, after 20 years, anybody can make it. But nobody will make before 20 years unless you cheat or copy or whatever. It means that the working life of this project, in this case, is drug development, is 20 years. So they know that they invest today, the cash flow they will forecast for 20 years, and then they will assume that when everybody start copying, then who will buy from? Because GlaxoSmithKline price is higher than the local the duplicate manufacturers. So in that case, the working life could be 20 years. Who knows? People still buy after 20 years, but you have some educated estimate. Again, you can't say, hey, 20 years is fine, but I know some people would still buy from me. Well, that is your upside. You always look at the downside.
So it is subjective, the number of sites.
Yes, it is subjective for sure, but it's based on some good arguments. It's based on some strong, some strong. Look, everything which is forecasted. See what are you doing? You're doing it now for 5 years, 3 years. You're not an astrologer, definitely not. Okay, but you make some educated guess because the life goes on the future forecast. We always plan something.
For example, in the machinery which have a